So our exam's on Monday. I forget what time, 5 o'clock maybe, or whatever. I have a prior exam, just the math problems. I'll put the essay question out there. But my concern is this is a problem we worked in class. I can't remember. This doesn't look familiar. We definitely do this one. There's the tip yields aren't going to be negative, so you don't have to worry about that, but they can be negative. You don't change anything, you just use a negative number instead of a positive number. Everything else is exactly the same. But so I might find a different exam put out there. I can't remember if we did this one. We might have done this one. I don't know if that looks familiar. It's been a while. So I'll make sure whatever I do for a practice video will be something we didn't do in class. So you might see a different problem out there. I'll have to do it, say, on Fridays because the exam's on Monday, and I'll set up a Zoom. You can sit on the Zoom if you want to ask questions, or you can just watch the video afterwards. All right, so these are the three math questions, right? You have these down at the end. So I'll work all of those. And then you have the essay question. That's the one you probably want to put some time into now that you got paper 2 done. So there's quite a bit of discussion here. This isn't the answer, but you can certainly flesh that out. So, introduction to me is the state asks the Department of Insurance to do this study to ask 2 questions. The 2 questions were, is there that should be disproportionate. Sorry about that. I don't even think that's a word, is it? Disproportionate impact. And the answer they got was yes. And is there a relationship between credit scores and frequency severity? Yes, but mainly for frequency. So those are the first 2 questions they asked for the first study. They didn't ask the third question, but the department asked the third question. So phase 1 was a univariate to answer these 2 questions. So, there's places you can bring out more. Since it's an open book, you can bring in that one graph I talked about that was pretty critical. And then phase 2, they said, well, it's true there is a relationship, but is it additive? Does it tell us something we don't know anywhere else? So they did a multivariate analysis to see, does the use of credit scores provide additional information? And they said the answer is yes, it significantly improves the pricing accuracy. So you need to get into that. There's more you can flesh out. We spent quite a bit of time on this. The more you can just flesh out on it. And then add into this, he doesn't talk about this, but we talk about it in class. What if you don't allow credit scores? Well, you're harming the people with good credit scores and you're helping the bad credit scores, but you can't have all winners. Insurance is a pass-through mechanism. So if you say you're not going to allow a variable to be used, then people that score well on that variable will be hurt. Those that score poorly will be helped. I think a big part of this are these 3 discriminations. Remember, I don't like the definitions. I think they're backwards, but unfair discrimination, intentional discrimination, those are both illegal. Unfair is when you don't have the actual support. Intentional is when you're doing it based on something that's illegal. You could have the support. You could say this group of people actually drives worse than this group of people, but it's not legal. All right. What about men versus women? Can you use that? Can you discriminate based on gender? You can in auto insurance. You can. I don't know about homeowners. I don't think they do in homeowners. Say, oh, you're a female homeowner. Okay, your rates are 10% lower. I don't think they do that. But on driving, they definitely do, right? Men pay more for auto insurance than women. But race, color, religion, national origin, those are not allowed. The last one, disproportionate impact, he says is the fact that we're using this particular rating variable going to hit certain racial groups or age groups. They do talk about age groups here, or gender or anything else. Does it impact them? And he says, of course they do. Everything does. There's very few variables that are equal with every single group. You're going to see some differences. So of course it does, but it's not illegal. Unless it's what? What did he use? What's that great phrase? The surrogate for something sinister. You remember that phrase? That's a great phrase. I wonder if he wrote it, but I love that phrase. So it can't be a surrogate for something sinister. It can't be, you can't use credit scores if it perfectly predicts race. But does it? No. People with good credit scores in all races drive better than people with bad credit scores in all races. You can't use it to perfectly predict. All right. So just to refresh your memory, because it's been what, about 7 years since we last talked about this. So it's been a while. Does that seem familiar? You have the two articles. You don't have to read the entire articles. In fact, you could quite easily just read the highlighted sections and get everything you need. So you don't have to go into all that detail. You do want to draw at least one graph out of the first paper to bring into your answer. All right, no questions. So that's going to be due at the time whenever the exam is. I haven't put it out there on Blackboard yet. No surprises. That is the exam. So I don't throw in wild questions. Maybe I should, but I'd rather have great answers on questions you know about than have you out there trying to study everything. And
there was on your example, one of those YouTube videos, seemed like I got the wrong answer. I tried to like do the math that you showed, one of the rates. I just kept getting the specific answer. You put that answer first, but you changed it.
well, there's always possibility of errors on my YouTube, so I can't really fix that. It's possible. I've had a few.
Right.
If someone tells me I don't change the video because that takes too much time, but I'll put a comment on the YouTube video that answer was wrong. This is the right answer. But you have to tell me if you see one, that is, and I'll look at it. But yeah, I can't. That's why it's nice having people work the problems in advance. And then if I have an error, they can fix it while I'm doing the video. That's a lot better. But once the video is published and there's just an error in there, I can't do much. Sometimes I'll have a transpose number.
Right.
But yeah, it's possible. Yeah. I don't know how many videos I've done, but it's in the thousands now. So there's probably quite a few errors in those things. All right. One thing I do want to finalize, because it is very, very important, especially if you get an interview with this industry, is cover. I'm going to hit just a few high levels on regulation, because it really is. This is a heavily regulated industry. You know, you could debate if it's more regulated than banking. Kind of depends. It's definitely more regulated than banking when it comes to the pricing side. Banking's really regulated on the making sure you don't go out of business kind of thing. They don't regulate prices as much. They used to, right? We used to have, was it Reg Q or whatever? We used to have it that interest rates were regulated, what rates you could charge or pay. That's gone away. So banking's probably become less regulated. Insurance is pretty heavily regulated. There's a big difference though between the life and the P&C side, and it's almost backwards. The P&C side is heavily regulated on rates. The life insurance side is not. Which of those industries rip you off the most? The life insurance side, but they don't regulate on rates. Auto insurance rates, if you call 5 companies and you take the cheapest one, especially the 5 biggest ones, you're probably getting a really good rate. Life insurance, there's some products, there's some horrible products out there that they're not 5% overpriced, 20%, they're like 100, 200% overpriced. And why are they so overpriced and still getting sold? Because they're sold by commissioned salespeople who have a strong incentive to make the sales. So the regulatory side has essentially let the life insurance industry get away with that. If you take my life insurance class, you know, I hate that industry for doing that, selling really horrible products because the incentive of the salesperson is wrong. Auto insurance is not really a commission-driven business, and it tends to be pretty competitive. If you compare Allstate to State Farm and USAA and Farmers, they're pretty competitive. And yet this industry is heavily regulated. Some people say it's because state law requires it. And since state law requires it, people complain, whereas life insurance is not required. So the industry lets them get away with overcharging people. The issue the life insurance has, though, is how they treat the customers. Do they pay their claims on time? Do they have good surrender fee? You know, it's more of not mistreating the customer. We don't care if you grossly overcharge them, but just make sure you treat them well. The P&C side, it tends to be to focus on the pricing side. And so there's an article, I won't cover the article just for the sake of time. It's a fairly old article, but it's written by one of the giants of the P&C actuarial world, Steve Darcy. I don't know if he's still around or not. I could probably find him, but just absolute giant. He came and spoke at UTSA. Looks like he's still around, right? They wouldn't have this site if he's a professor emeritus, because he's probably retired. Yeah. So Elizabeth, you should email him. Get you a job. Who are there other actuaries in here? I can't remember. Yeah, Gilbert. Yeah, he's a giant. I don't think that's a recent picture, because that's what he looked like when I met him like 30 years ago. So but really a giant, definitely a giant in the actuarial world. But it looks like he's still around, so I don't see anything says he's not. But he wrote an article about regulation insurance. And the question was, why is insurance regulated on pricing when most other things aren't? Like if you go buy a house, do regulators tell the banks what rate they can charge you? Not really, because you can go to another bank, you can shop around. It's pretty easy to shop around. You know, when you buy groceries, I mean, can you think how many places do you go where the government tells you what price you have to pay? It's not a whole lot of places, but insurance is one of those. And people might say, well, insurance is complicated. That's why you have to do it. Was auto insurance really that complicated? You understand? Well, I mean, some of you have part B and C and don't know it, but part A and B are pretty, part A and C are pretty, A and D, liability on the A, physical damage, pretty easy to compare. Yeah, it's true. You have different limits and all that. You may not be able to get exact comparison, but you could go to 5 companies. It might take you an hour and a half and compare rates pretty easily. It's not that difficult. What about on the life insurance side? Well, there it's a complete different story, because the products are so complicated. No telling what you're paying for. But on the auto side, not so bad. Homeowners, especially, not that complicated of a product. So why do we need insurance regulation? And so he says part of the problem is at the time that he wrote this was that auto insurance premiums are rising really fast. But that was just in that particular time. Recently, we've seen other things going up in prices and inflated more than auto insurance. So that was just that particular point in time. And so the question is, why is this? And the regulators need to step in if it's antitrust. So that's the big issue. Is it antitrust? And so he asked the question, does regulation help or hurt? So the first way you get asked that is, states that are heavily regulated, did their customers pay less for auto insurance than in states that aren't heavily regulated? And the answer is yes. You're in a state like California that's heavily regulated, you do pay lower rates than in states like Wyoming that aren't. That seems to imply that there's some benefit to it. But when you're forced to charge a certain rate, you're going to cut back in other areas. So there's a harm side. So and our insurers are not making adequate returns. So essentially they're overcharging the other states to make up for that. What are the causes? What are the concerns? Why is all this going on? So we talked about this before. This is really, really critical to understand. I wish I could make a mnemonic to remind this, but states will say your rates can't be excessive. That relates to affordability. They can't be inadequate. It's almost like the states don't care about that one anymore. Yeah, you can undercharge. We don't care if you go out of business. And that's been a big issue in a state like Florida on the homeowner side, where new companies will come in and undercharge and just hope there's no hurricanes for a few years. Pick up some business. If they're lucky, they got a business and they can raise their rates. If they're not, they go out of business. And there's some of those that have started in multiple states, just keep starting, just hope. You got a good chance. You can go 5-6 years without a major hurricane. It could work. You undercharge. States tended, used to be the only thing they looked at, but the affordability has been kind of their big focus, especially in those places that have an insurance commissioner as an elected office. Can't be overly discriminatory. We already talked about that. And then availability. Remember, the insurance industry, when they get beat over the head about affordability, they bring up availability. You don't let us charge the right rates, we're just not going to offer the insurance. If you let us charge the right rates, yeah, some people won't be able to afford it, but that's because they have really high claims. But some people in that area will be able to get insurance because they have good credit scores or whatever. So, so you always see the insurance industry bringing up availability, where consumer groups are talking about affordability. And so when insurance companies are being regulated, it's usually the focus has been on cutting rates. So is antitrust an issue? And you probably learned Herfindahl. It's kind of spelled like itself. Herfindahl, did y'all study that in your economics classes, maybe? You remember that? It's a really easy ratio to calculate. I've done it for the insurance industry. Real simple formula. You have to get market share to be able to calculate it. But once you get market share, it's quite simple to do. So you take the market share just as a number, not as a percent, and you square it. And when you square it, they may give you some numbers in here. I actually don't square the percent. I square the actual number. So their number is going to be a little different. But when you square it, you add it up. If it's really concentrated, you'll get a big number. If it's not concentrated, you'll get a really small number, because when you square a big number, you get a really big number. When you square a small number, you don't get such a big number. And so, yeah, I'm like, so the real key is if you get above 1,000. So let's think about this in terms of, let's say there were two companies. So you add those two together, your Herfindahl score is 5,000. That's a concentrated industry. Just two companies, each have 50%. So if you're over 1,000, you got a concentrated industry. Let's say you have 3 players that are 25%. That's a pretty concentrated industry. What if you have an industry where everybody's 10%? Well, there you get your 1,000. So industry where everybody's 10% equally, that's right on the cusp of being a little too concentrated. You could have one company that's 25%, everybody else is 1%, and then you're okay, because that's not going to give you that's only going to give you 700, right? Because you're going to have 625 plus 75. That's only going to be 700. That's not very concentrated. So it can depend. If you had one company that's 99%, obviously that's a concentrated industry. Where did 1,000 come from? I don't know, but that's what the regulator is supposedly looking at to see if an industry is concentrated. So how would you do this for insurance? Well, the way I did it, first of all, you can't just take, I use revenues, because we're talking market share. Market share I do on a revenue basis, not on an earnings basis. I use revenues, but I can't just take State Farm and Allstate and Hartford's revenues, because they're all different businesses. So remember that SNL database. So I want their homeowners insurance in Texas. Can you get that? Remember the state pages? You have all that details. So homeowner revenues in Texas. I can get, how many companies would you have to do? Well, with SNL, you can get every single one of them if you want. It's a piece of cake to do. And you have to do every one of them, because remember with Texas, there isn't Allstate of Texas. It's not Allstate Texas business. It's Allstate and their 20 county mutuals, that you can find all of those. So you do need every company. And so that's the toughest part. But if you remember on the Jurit page that I showed you for Allstate, that first page gave you the NAIC group code. That group code tells you they're all state related. So you bring in the code, bring in all the companies, you bring in the group code, you bring in their Texas homeowners, you sort them by group code, and that's going to tell you concentration. So I would include all states, county mutuals, and Lloyd's as part of all state. When you do that, the last time I done it, and it's been a while because I don't have access to SNL anymore, but I just showing you another great application for SNL. When you do that, I was getting a number in the 900s. So kind of close, but not so much. And why is that? Well, when I did this, State Farm was about 25%. Allstate was about 10%. USAA, Farmers, they're each about 5%. So you're getting up into 800s just with the top 4 or 5. So there's a few others. It kind of depends if you're talking auto or home, because if you're talking auto, you got Geico and Progressive that don't really do the homeowner side. If you're talking home, then yeah, there's a few companies, the Hartfords and some of those can have a pretty significant allocation, but it's pretty easy to do. I remember I got a number kind of in the mid 900s, but again, that was nationally. So this article says you can't do it nationally. You got to look state by state, because if you live in Hawaii, the fact that the US is 900 and Hawaii is, 400, because there's only 2 insurance companies there. Yeah, unless you want to, I guess like someone in Hawaii could, well, I mean, what else are you going to do? You can't buy insurance in California if you're going to drive in Hawaii. So there are some states that are very, very concentrated, but most are probably okay. I don't feel like it's a antitrust. I feel pretty confident if I go to State Farm, Allstate, Geico, Progressive, I'm gonna get pretty competitive auto insurance. I don't feel like they're calling each other. But Elizabeth, something you're gonna notice the first time you meet with someone that's not in your company, the first thing they say, every conference I go into, there's a time USA invited several companies. The first thing they say is, we're not here to talk rates. Everybody understand that? Yes, and they put that in the minutes. We are not here to talk rates. Even at the actual conferences, the very first thing they say at the beginning of the meeting, we're not discussing rates today. And then they talk about rates, but they're not officially talking about rates. It's because of this fear of there's some collusion going on. I know it's cutthroat competition because I know what our CEOs bad mouthing the competition constantly and saying we're going to put them out of business, all this kind of stuff. So it's a competitive industry. So is that an issue for this industry? It's kind of close. With State Farm and Allstate, you got 2 big players right there that are somewhat concentrated. But Progressive and Geico have done a good job of stealing a lot of business from State Farm on the auto insurance side. The other thing you have to look at is economies of scale. Sometimes industries get concentrated because they're providing incredibly good product to their customers. Some people complain about Amazon because they're picking up so much online. They're kind of faltering here lately, but Amazon, but yeah, why is Amazon so concentrated? Well, because people love the product. It's a really good product. It's convenient. It's fast. They deliver stuff quickly. So they have a large market share because they're providing a very good product to the customer. And that's somewhat true with Geico and Progressive, with these direct writers making insurance much easier to purchase on the internet. And their market share is growing because they're cheaper, because of direct writers, and they're doing things on the internet. Very different business than State Farm. You see all the little State Farm boxes sitting around the city. That's a different clientele than Geico and Progressive that does this non-commission based online direct. Now, USA used to be the largest direct writers, but these 2 players have come in. Could it be inefficient management? Are they just wasting money? So yeah, when I was at USA, that was the case. Our expense ratio got up to 30%. When Geico and Progressive were below 20, and then Bob Davis had a major restructuring. He laid off 25% of the workforce. This industry can get a little bit like that. Banking's the same way, where they have their periods where they're making a lot of money and they do get a little waste. I think it's just when you're spending someone else's money, you tend to be a little wild. I remember USA, this one lawyer, he was like, we were on the corporate jet talking about spending money, but he was like I'm always flying first class. If I'm flying for the company, this is an inconvenience. I'm flying first class. And my boss looks at me like, see, I told you, Ron. It's like, no, I'm not flying. I'll fly first class if I'm paying for it. But if someone else is paying for it and they're deployed in Afghanistan, I'm not spending their money on first class. So I had a different opinion of that, but that was their thing is, hey, I'm traveling. It's an inconvenience for me. I'm going to be up in first class. Would they ever spend first class on their own personal travel? No, because it's too expensive. So yeah, we tend to be pretty wasteful when we're spending other people's money. How do you incentivize firms to do that better? I don't know. I think competition is the main thing, and Progressive and Geico have put that pressure. They put that pressure on USAA, and USAA had to cut expensive. Some argue lax claim settlement. I have heard people make that argument that I had this fender bender. There's no way that that was more than $200 in damage, and I just found out they paid a $2,000 claim, and they didn't even question it. I was kind of shocked when my car got broken into and they stole my bike. I didn't know what to tell them because it was a $1,600 bike, but it got replaced with a $2,500 bike because in all of that. And I told them all that, and they replaced it at the more expensive. I was like, okay, they didn't question me. They didn't want any evidence. They didn't ask for receipts to prove all that, they just paid it. But why is that? Because they don't have time to mess with it. It's like, okay, this guy is the only claim he's ever had. Let's get him off the phone. Let's get rid of him.
How was the experience?
Huh?
How was the experience?
It was really simple. I was shocked. I mean, at the end of it, I could have told them anything. They would have paid it. I told them the truth, but I could have told them anything and they would have. Huh?
They're not consumer your fine. Unless there's.
Oh, it's so blatant. My $47,000 bike.
Yeah. $1,000 price.
It had Van Gogh painted and all that. Yeah. That.
$10,000 Prius.
Yeah. And bikes, they probably had some, I mean, that's probably true. They probably had something they could look at and see, okay, this is titanium, a bike. It looks like a good brand. Yeah, I can see that that's worth that much. So if I'd gone too high, because there are $6,000 bikes out there, but my brand wasn't that kind of bike. So I don't know. There are probably ways they can check that pretty quickly to make sure it's at least reasonable. Now, this was true in the 60s before interest rates got very high, that a lot of insurance companies were just banking the investment income. And that was kind of something that was kind of understood in the industry, like, yeah, we get to keep all the investment income. Again, Geico and Progressive coming in, the competition, if you made more than the investments, you had to pass that on to your customers. But this explicitly now, regulators require you to pass that on to your customers. Now, the other one was fair profits. Are insurance companies raising their premiums because they're making excessive profits? That really gets back to the antitrust, because you can't make 20% returns in an industry. There's a lot of competition because new players will come in and try to gain that 20% return. So are insurers earning too much? And this is really, really tough because how do you measure it? You should be looking at market returns. You look at market returns, the insurance industry has been a pathetic place to invest money. So you can't make the argument that they're overcharging. Look at all these wonderful stock returns, because that's not the truth. Regulators look at statutory. And looking at statutory, they say, here's the returns. Well, you can't look at statutory. I mean, it's just so blatant. You just give me an obvious example. Let's do, let's do Amazon. So Amazon's price to book is 7 times. You take their earnings and divide it by the book value, you get a 20% return, or you get a 28% return. What is that on the market value basis? Well, if you're trading 7 to 1, that 28% return is only a 4% return. So the return to the stockholders is based on what they're paying. They're paying 7 times gap for the stock. So management can't make a 28% gap return because that's only a 4% return to their stockholders. Now, what about the insurance industry? Well, the insurance industry now is trading pretty cheap. Their price to book, but it's still 2 to 1. So if your this is GAAP, so if your statutory return is 10%, to the stockholders, that's only a 5% return. So again, now of course the GAAP side, you're making adjustments to the true economic return versus GAAP. GAP's conservative, but it's not that conservative. So the ultimate grade is the stock market. And that's the easy one to do. You can go back and see the actual returns of the stock market. And it's pretty pathetic. This has not been a great, I should have brought in some numbers on the stock market returns. I forgot to do that, but it hasn't been a great industry to have money in. And the key is, and this is where the regulators really messed up. The regulators look at their actual historical return on equities and they say, see, you only made 6% the last 20 years. So 6% is obviously all you need. And the industry saying, yeah, but those were a horrible 2 decades. We had these major events happen, all this kind of stuff. You can't say that what we realize as a return is what we require return going forward. There's a good reason why our stock returns have been so pathetic, because we haven't produced good returns. And the regulators are saying, yeah, but that's you lived with that in the past. So you should be happy with the 4 or 5% return going forward. So you can do this a lot. Regulators are not really good at this, but anyway, you try to win that argument. And then fairness to the policyholders. Should city dwellers pay more than rural drivers? If you're a city dweller, what do you say? No, of course not. That's discriminatory. If you're a rural driver, what do you say? Of course, there's more theft, there's more traffic, there's more accidents, obviously. And then you have the spiraling effect that he talks about here. He talks about these market failures. That's probably even a better term. Market failures. When you don't allow insurance companies to charge the correct rate, the people that are undercharged buy too much insurance, people that are overcharged buy too little insurance, and what happens then? Then you got to charge more because you got much worse driver, and it just spirals out of effect. So a few states, New Jersey, Massachusetts, there's been some states on the auto side that have just completely broken down. New Jersey had a governor's race. It could have been Christie. I can't remember. About a decade ago, where auto insurance was the #1 issue. That hasn't really been the case in Texas, has it? Where you have a governor's race based entirely on auto insurance rates. But the New Jersey auto insurance, that was it. Everybody was debating that one issue. Florida, it has not been the #1 issue, but homeowners insurance in Florida has been a major issue. And so, you can't have it get so bad that people are losing political races because it gets so out of whack. How accurate are the rating classes? So that's the other question people are asking is, you're charging me too much because you shouldn't be charging on that variable. Young people don't drive worse than older people. That's not fair. And the proxy variables, like we said, the credit scores, it's not even fair. Solvency concerns, no one seems to care about that anymore. And plus the way the guarantee associations work, it sounds like the insurance industry covers itself, but it really doesn't. Because what they do, I learned this pretty quickly because we did a lot of tax credit, premium tax credit investments. When an insurance company goes under, the rest of the industry has to contribute money to pay that off and pay off all those claims. So that sounds like the insurance industry is paying for it. But then what the insurance industry does is when they pay these fees, they get to offset those against their premium taxes. So they just pay less premium tax to the states. So ultimately, who pays is going to be the taxpayer. It's going to be some of the insureds as well. But so, who knows who's really paying for all of this. So overall, what's the main argument? He said, really, the reason insurance is so expensive is because claims have risen quite dramatically, and it's pretty obvious. We have much, claims are going up because frequency is going up, severity is going up. You had mold in Texas, you have hurricanes. Back in 1980, the speed limit in the United States. Maximum was 55. Now it's what, 75, 80. There's places in my Prius, it's like I can't go that fast. It's like I need to, downhill, I can go to speed limit downhill. So obviously, what happens to frequency and severity when you increase speed limits from 55 to 80? You have SUVs driving around, which cause a lot more damage. Claims are going up because claims are going up. I mean, premiums are going up because claims are going up. His possible solutions were tort reform, fraud reform. I don't think those are massive ones. We talked about that earlier. More efficient operations, but ultimately, insurance is a pass-through mechanism. They charge more because they're paying out for. So I guess one we should add here is telematics. I'm really interested to read your papers. I'll reread them today, tomorrow, Wednesday. Hopefully by Wednesday I'll have them all read. Several of you, I think half the class is doing telematics. Did y'all learn something new? What was the most amazing thing you learned that we hadn't talked about in class? Telematics. Somewhere in your paper it says, I was very surprised to learn that. And what did you write there? Y'all didn't learn anything?
I think it's surprising where it derived from. In fact, the tracking spy scenario.
Tracking what?
The whole the way I read it was it made it seem like that there was information about how it all started as a military program.
Oh, really?
Yeah.
Kind of like the internet and everything.
During the Cold War.
Oh, really? So like tracking car, these are, oh, that's interesting.
Or just like, I mean, anything with regards to like spy, where they're at.
How did they track before GPS? Oh, the GPS was created for military reasons. Okay. Yeah. Oh, I was a GPS. I put on Facebook once, if I could go back to high school, what could I tell them that they would least believe? And I think GPS is one of those. None of y'all have used maps before. It's like the most dangerous thing for a driver. You're like this. The fact that I can plug something in is going to tell me how to get there. That GPS can track how close within less than an inch, right? Less. I mean, it's ridiculous. So,
I found an article that was like 2 meters for like GPS. Like the satellites are like roughly two meters off.
Well, 2 meters sounds, and especially if you're turning into a street. I thought it was less, but I mean, it's still pretty amazing. I mean, it's so telematics, specifically targeting drivers for their actual knowledge, their hard braking, their use of their cell phone, those kind of things. It's hard to argue with that. What did y'all decide as far as credit scores? Could this replace credit scores? Is this a better way? Could it replace everything? Can young drivers, men, women, everything goes away, everything's 100% telematics or not? Did any of y'all go to Root's website and read what they're doing?
For Root, I know I've had put in my paper that Root was basically going down like a list of a whole bunch of stuff, whether you were a full-time student, you could get a specific coverage. I think it was like from 5 to 25%. You had to send in a transcript of your grades for that. I think there was one if you're military, I'm not too sure. Another one was like your age. And I think they took an account of like your driving record as well for like a discount.
Yeah, I think most of those are, well, the colleges and grades, most of those are pretty standard. So what percentage of theirs is telematics then? Because they advertise themselves as an AI telematics firm. So it'll be interesting, it might be telematics on the fringe will help 10% of drivers that would have been false positives, those kind of things. The thing is, since he wrote this article, it hasn't been as big of an issue. It seems like it's been somewhat solved. New Jersey, Massachusetts seem to be functioning now. Homeowners is still a big issue in the hurricane and earthquake areas. So it seems to somewhat have been resolved. I mean, how many of y'all are just irately upset with your auto insurance premiums? It's not that big of your part of your budget, is it? It's not something you really notice that much. So it used to be a huge deal. It's not as much, and it tend to be really state specific. So, but it is more regulated in certain states than almost any other product. And this article is just asking why. Why is it? Do we really need it? What would happen if there was no rate regulation of auto insurance? Would it be a disaster for consumers? What if the state stopped regulating the price of Pepsi and Coke? What would happen in your life? You went to HEB, you wouldn't notice, right? Because they're not doing it now. So why is auto insurance so different than these others? And why do they care about auto insurance when we know the life insurance side is absolutely ripping people off? Why don't we care about that side where it's so blatant? And then they have some market conduct on that side, but they sure don't manage it very well. And it's a tough question. I don't think he really answers it in here. I don't think tort reform and fraud are the driving forces for auto insurance rates are so high. But, I do think one of the reasons why it hasn't been as big of an issue is because of Geico and Progressive and Allstate. I think a lot of the kind of the second, it was State Farm, and State Farm got a little bit inefficient and not well run. And I think the competition came in. And so I think part of this is the competition's really been pretty strong. Geico, especially in the industry, bailed Geico out in the 70s. They kind of wish they hadn't done that. And so that changed. I noticed the competition because Bob Davis, strange, he put a bunch of Geico advertisements in the hallways of USAA. That's strange, isn't it? And he was really upset that we weren't ripping them down. It's like I don't even notice that they're there. It's like, would you rip them down in your company if someone put the? I just thought that's just so strange. What is he trying to test our loyalty? Like this is Joseph Stalin all of a sudden or something? I didn't understand. It seemed weird to me. Some people did rip them down, and I guess they got a big promotion or something. I don't know. But anyway. All right, so I think the industry is pretty competitive. I don't really worry about my auto insurance rates. It's not a big part of my budget. I feel comfortable. I could shop around, and I do recommend people call 5 companies, get the best rate, go for it. The quality of the services may be important, but I don't have any accidents, so it's like I don't care if the claims experience is a little subpar because I only see them, once every decade or so, if even that. So, all right. I'll real quickly, on regulations, there's a few things you definitely want to know. Regulations started in the 1800s, mainly for, life insurance and homeowners, fire insurance, really more than anything else. Fire was a big issue when you're putting up a Christmas tree with lit candles, fire can be an issue and you have fires in your house. Auto insurance obviously wasn't an issue back then. It was primarily actually focused, making sure rates were adequate and that you had reserves, because obviously we didn't have the mathematics back then. And so a big debate came up with who's going to regulate these people. And it seemed like it's pretty obvious that the federal government's going to regulate them, because the federal government regulates any business that crosses state lines. They cross state lines. They regulate the banks. Why would they not regulate this? And so this guy, Paul, that was what he thought. I want to sell insurance. I'm from New York. I want to sell insurance in Virginia. Virginia says, no, you have to be licensed with the state of Virginia to do business there. He said, no, go drop dead. I'm from New York. You can't control me. You can't give an advantage to Virginian salespeople over New York salespeople. Took him to the Supreme Court. Says, I won this case. Pretty straightforward. It's interstate commerce. Interstate commerce that belongs to the federal government. And what did the court decide? Insurance is not commerce. What they decided. It's like, what? And you can read, I've read the case. It's not a very long case. You can read through it. So strange. If banking's commerce, why would insurance not be commerce? And they did get a little bit into, well, you don't actually get something. You don't get a box of stuff. But that's true with banking too. So it was a really strange regulation. I think part of this was the year this was done. I forget what year the Civil War ended.
1865.
65. All right. Did you know it was April 9th?
On there.
So 65. So this is a time where the Supreme Court was kind of heavy states' rights. And there were obviously a lot of debate. And then you have Andrew Johnson, who was, you all know back then, presidents and vice presidents didn't have to be from the same party. So, Andrew Johnson wasn't exactly a Lincoln protege. And so you had this pretty serious debate going on, states versus federal government. And the Supreme Court at this time was siding with the states and stuff, to Lincoln's pretty much chagrin. And so part of this was probably a political side of just the Supreme Court at that time, just deciding, hey, my word, we just had the Civil War and it didn't go the way we were hoping, and all that. It was a pretty seriously politically charged time. The federal government regulates commerce when it involves residents of more than one state, interstate commerce. Paul says, yeah, duh, just an easy case, slam dunk, and he lost the case. And so then the state said, well, you know what? Now it's our problem. So they started building the infrastructure for all of this. Well, now the United States is doing pretty well financially. It's coming out of the Civil War. You've got a lot of industry, especially in the northern states. And insurance is a big part of that. And corporations are saying, well, but now we got to deal with a regulator in every state. And I don't know how many states there were in 1871, but there's, a growing number of states. We're moving west. Companies are saying this can give United States, our companies, a huge disadvantage. We have to deal with all these insurance companies. So the states got together and they developed the National Association of Insurance Commissioners. It's all the state regulators getting together. They have their website that I showed you earlier. And their goal was to make it much easier to deal with all this regulatory infrastructure.
That's kind of positive before the Reconstruction era, right?
Well, it's probably during the Reconstruction era.
A little bit after.
If the war ended in 65, so kind of that area. What actually causes, it was probably more than anything else, insurance companies complaining as they're expanding to other states. It's like, hey, this isn't fair for us to have all these regulators. So they promoted uniformity of laws and regulations. The annual blank that we looked at for all state, that's one of the first things they created. So everybody has the same accounting. Let's simplify that. They create what's called model laws, risk-based capital that we looked at earlier. That was a model law. That was probably their most successful model law. How you value things for accounting, valuation of investments. And then they tried this thing with accreditation. It didn't really work, but saying which states regulators were accredited. And what they're trying to do is say, hey, we really want Colorado to have this model law. And if they don't pass this law, all the other states will refuse to take their state auditors' reports, and we'll have to send in. But they're kind of worried about the Supreme Court stepping in and saying, okay, you guys have gone too far. You can't do that, especially when the state of New York wasn't accredited. And the state of New York is the most powerful regulator. When they say, and you're not accredited, they're like, okay, game's up, throw this thing out. So they're trying to give it more power, more teeth. They do quite a bit. My boss, oh my word, the reason he traveled so much is he was going around meeting all the state regulators. He had quite a bit of influence, actually. In fact, there's one time in his office, he picks up the phone and calls the state of New York's insurance commissioner. Going, can you really do that? Oh, yeah. I talk to him all the time. And the guy answered the phone and he talked to my boss. I was like, wow, I can't believe, but it's a very political position. You're trying to influence them, a lot of lobbying, but they take this pretty seriously about wanting to make the insurance industry as efficient as possible, but not overly burden them. And so that happened in 1871. In 1905, talk about another president, you got Teddy Roosevelt. You got a lot of books being written about what was the jungle. I don't know when the jungle came in, but a lot of books about, we got child labor, we got bad meat packing. So a lot of regulations came in, including on the insurance side. The New York had the Armstrong Committee, mainly working on the life insurance side about really bad sales practices. But what you really saw in 1905 was a huge increase in regulations, kind of to the detriment of the insurance industry. And then 1944, everything changed. Southeastern Underwriters Association. That's a group of I guess really actuaries, but underwriters. And they're meeting together with their member companies. Their member companies are these small companies who need help setting their premiums because they don't have the actual support to do it. And so they're all getting together and deciding what premiums to write. And this US government says, well, wait a minute, that's antitrust. You can't be doing that. But antitrust laws were federal laws. And what do the Southeast Underwriters say? Hey, federal government, we're not commerce, leave us alone. The Supreme Court's already decided that antitrust has nothing to do with us. So what does the Supreme Court say? Y'all notice the difference here. What was the first? Paul versus Virginia. This is someone versus the US government. It's a little different. So Paul was saying, Virginia, you can't regulate me. Southeast Underwriters were saying, US government, you can't regulate me. And then you go to the Supreme Court and they reverse a decision. If you actually go out and Google how often does the Supreme Court completely reverse a decision, this is one of those times that they did. They say insurance is commerce. This one's a much lengthier discussion. And part of this discussion that they had was, we agree insurance is commerce. We agree the federal government should regulate it, but the infrastructure is all state. And so some of the judges are like, if we undo this, you got all the state regulation, you have no federal regulation, we're just going to be, what's going to happen in this industry? We're just going to have this unregulated industry. But they went ahead and reversed it, and in Congress very quickly. So this is something you need to know, the McCarran-Ferguson Act if you interview with the insurance industry. Very, very famous act. So McCarran-Ferguson got together and they said, okay, we're responsible for insurance regulation, but there's nothing in the Constitution that says that states can't, the federal government can't delegate their responsibilities to somebody else. They can't hire someone to do something. And so federal government, we are going to hire the states to do our regulation for us. We're still responsible for it, but we're going to outsource it to the states. The state says, sounds good to us, we're already doing it. How do you pay the states? Well, states, you can keep collecting those premium taxes you've been collecting, and that's how you'll be compensated. And that's what they came up with very fast. You notice that? 1944, 1945. Very, very quickly. Has this been tested? Yeah. President Obama, actually, I was watching him on TV talking about McCarran-Ferguson. See, I told you it was important, right? The President of the United States, what is he saying? We got to get rid of this thing. It protects health insurance companies. They're colluding. He wanted to overturn for that purpose. And they didn't get it done. It looked like it could happen when the SNLs were all crashing back in the late 80s. They were going to do away with McCarran-Ferguson there. It was just like a foregone conclusion. It was going to happen. In fact, they had the votes, everything was set up, and then they got distracted and they forgot about it and just went. We were all scurrying around. Our lobbyists were up there. Everything's going on. But it was like, no, you guys are going to lose. Get ready. You're going to have federal regulation. And then they just, Congress gets distracted. Something else came up. And so it didn't happen. They have what's called the safe harbor. So insurance companies are exempt from federal antitrust if they're in the business of insurance. So, Microsoft would love to be exempt from antitrust, but Microsoft can't go out and sell one auto insurance policy and sell an insurance company. That doesn't work like that. So if they created a subsidiary that was an insurance company, that insurance company would be exempt, but Microsoft wouldn't be. So you have to be in the business of insurance to get that safe harbor. And states do regulate antitrust as well. So it's not like there's no antitrust on the insurance side. That's why actuaries always say, hey, we're not talking rates, because the states look at it as well. But they do have an exemption from the federal antitrust. The federal government has stepped in a few places. Probably the biggest one is this Valak versus US. That's the life insurance, but the federal government decided that certain life insurance products are investments. So they're both insurance and investments. And investments are regulated by the SEC. So if you work for a life insurance company, you may have to have both a state and a federal license to be able to sell products, because you're selling both insurance and investments. To 2008 probably helped the insurance state side because the only large insurer that went under was AIG, and it had nothing to do with the insurance practice. So where banks are going under left and right, and we're seeing the same thing this year. You haven't heard any insurance company struggling this year, have you? It's just not hitting the press at all. So banks go under, that's the federal government, and they're messing up. States are like, hey, AIG, nothing else, leave us alone. We're doing a great job. So what does the industry want? Well, it depends on where you work. I worked at USAA. Bob Davis, he wanted an optional federal charter. You want to say insurance companies have the choice between being regulated by the states or being regulated by the federal government. He was a very small minority in the industry. Most of the industry said, we know what we have, we hate it, but a known horrible government regulator is much better than an unknown horrible government regulator. We'll stick with what we have. And what their fear was that all the rate regulation would stay with the states and all the solvency regulation go to the US government, and we'd end up with the worst of both. And so that's why Bob Davis was kind of all by himself. Now, he was adamant on this to the point I saw him saying, you'll get this done in the next 6 months, or your replacement will get it done in the next 9 months. He was that kind of, this will get done. And those poor guys are like, we're doing everything we can do. I mean, it's, you can't force the industry to support this. ICT, the Insurance Council of Texas, big issue for them because USA is one of the biggest clients, but all their other clients, so they just kind of had to ignore this. Small insurers don't care because they're all in the same state. They got set regulation, they don't care. So yeah, the industry, I think once Bob Davis left, I don't think Joe Robles took this up at all. I think they just dropped it. It wasn't that big of an issue for them. But this is a very regulated industry. I always tell students, you're interviewing with in finance or actuary, it doesn't matter either one. You're paid for complexity. So you got to make sure that you're learning complexity. In fact, you need to find the job that scares you the most that you think you could learn, because the more complexity you know, the higher you get paid. And where does complexity come? Well, in finance, it's often the industry. So where does complexity come from? Well, a lot of times it's the product itself. So for insurance, life insurance, the products can be really complicated, but that's because they're horrible products. It's not because it's some great technology that you got to really understand. Auto homeowners, the products aren't that complex, but there is some complexity to them that you have to understand. I think here it's the pricing and reserving. So if you're going to work for an insurance company in finance, you got to go figure that part out. That means you got to go talk to the actuaries. Where does the complexity come from? In insurance, it's pricing, it's reserving, it's the Schedule P stuff. So what I did in my career, every time I got a number from an actuary, I said, I need to go talk to them and figure out where this number came from. I really didn't, because I didn't really need it for my job, but they didn't know that. So yeah, you just gave me this number. It's up 10% from last time. Can you explain that to me? And they did. They didn't really need to, but they didn't know they didn't need to. And so, yeah, I used it. Anytime I got a number I didn't understand, I went and found something. Can you explain this to me? And they did. You know, companies are nice people. A lot of them actually like it. They have this newbie, and it's like someone wants to know about what I do. It comes from the product itself. It can come from the accounting. For insurance, the accounting is very complicated. How do you learn that? I spent 13 months doing insurance accounting. That was exactly the right amount of time. You learn it fast, because in accounting is like laundry. It's the same. You're washing the same shirt every time. So it's complicated, but when you do it every month over and over and over again, you learn it, especially if you ask those questions. You got to ask those questions. The guy who audited me from Pete Marek, he audited me 3 years in a row. He knew nothing about insurance accounting at the end of the 3 years because he never asked any questions. His whole job was to fill in the audit worksheet from last year. He didn't ask a single question about anything. He knew nothing. Wasn't that sad? 3 years, and he knew nothing about what he was auditing. I asked a lot of questions to the accounting. And then another place it comes from is the regulation. And for insurance, it's the regulation. You got to learn you've got to learn all these pieces. So I spent a lot of time. In fact, my job when I was on the corporate side was dealing with regulators, the NAIC. So I learned that side of it. So you got to find some way to get into this. Some of these products, let's like HEB, it's the supply chain management. You got to learn that. That's really pretty critical. So it kind of depends. Every company has something that's really complex. And if you're not learning that, you're wasting your first part of your career. So you got to find some way to jump into that. If you're working at Valero and they say, hey, do you want to spend some time on the trade desk? You say, yes, I do. Because that's the most complicated part of Valero. I've had students at USAA. We had one former student. He worked at the trade desk at USAA. It's a rough job. You feel so stupid because you're working with these people and know the stuff backwards and forwards. Guess what? You want to feel really stupid in your job. Why? Because complex stuff makes you feel what? Makes you feel stupid. You just have to sit there and take it because it's just hard stuff is hard to learn, but once you learn it, you're now worth 3-4 times what you were worth before. So when you get that job, it doesn't matter if it's insurance or banking or any other industry, figure out where the complexity comes from and somehow get into that department and ask questions and learn that complexity. I know people who avoid the complexity because they're scared of it. You've got to do the exact opposite and go after it. So the insurance industry is not a bad industry to sink into because you're going to learn stuff that is just really hard to learn. And once you learn it, it's going to transfer to other companies. It's not like what you learn at USAA is not going to work at State Farm. It's going to work. You're going to learn it and it's going to work really, really well. All right. So that's it for me. Our exam is Monday at some time. Anybody know? Is it at 5 in this room? The essay be due at 5. And then you'll have the math questions. I'll work the math questions probably on Friday and put it out on YouTube and you can jump in on the Zoom.
Yeah, it says Monday on Tuesday. I assume we meant Monday.
What?
It said Tuesday the 8th. It's meant Monday, right?
I said that or?
On the paper, on the,
Maybe the essay question.
something like that.
I
Says
can't
the 8th.
remember.
What's on that initial document?
I can't remember. Yeah, it's whatever the official UTSA is. So I'll email it out to make sure. But it'll be in here. You probably won't need the full time because it'll just be the math questions, but just bring a calculator and be ready to go. All right, that's it for me. If you're graduating, good luck. Keep me posted on how you do.